Welcome back, everyone, to another episode of Ready, Aim, Retire, the show that focuses on helping you build legacy, manage your retirement through expert wealth management. I'm Rob Kirvan, your host. As always, I'm here with Tony Shore. Tony, kind of a little clunky coming in today. We had some technical issues on your end.
We had a lot of technical issues.
You did.
I'm not 100% sure they were all on our end, but Rob,
they were interesting, but we got through them, and here we are. So I'm just glad that it all worked out and that we were able to continue doing this.
Well, Rob, I've never sat down at the mic and started to speak, and my voice came through the recording sounding like a demon.
It did. It did. It was
the voice of Satan.
It was quite odd.
What's going on?
Yeah, my guess is I watched the whole thing unfold as you bumped something on the way in, but who knows? Who knows what probably happened.
No, didn't touch anything. It was like that when I walked in. In fact, Jay said, I was talking before I got here, and he goes, "Your voice sounds like a demon." And I'm like, what? That's not right.
All right, we're here now, though, which is great. So,
Rob, good to see you. Thanks for having me on the
show. As usual. Today, Tony, we're going to talk. I don't want to say we're going to get all into it. Enhanced planning is a big topic, and everyone's talking about it. And our clients, being, probably 70% of them are retired. So usually the way it goes is you're retired for a while, then you have some grandchildren, and then you start thinking about, wait, what's my legacy? How does this look? How does it turn out? So I want to focus. We're not going to be able to hit everything, but we're going to focus on a few points today. But the main point is, when you pass someday, and no one wants to talk about that, I get it. But when you pass someday, do you want one of two scenarios? Do you want them looking down? You're looking down and your family's around your kitchen table saying, "Oh my gosh, Dad really screwed this up. I can't believe he was this disorganized. This is so much work. How do we tackle this?" Or would you rather them looking down and saying, "Man, Dad was really organized. He really had everything that we needed here that's going to help us out to, kind of move this thing along." And everyone has the same opportunity to have either one of those outcomes, and it's through enhanced planning, through sitting down with somebody, through, working with somebody that handles these types of things. So what we're going to talk about today is the ways assets pass to your beneficiaries. We run into this at least a couple times a year. Someone passes, and, the way the assets pass are critical, and we're not going to get into the whole trust thing today because we have a special guest I'll announce shortly. We're going to go through beneficiary designations, critical in enhanced planning, making sure your ducks are in a row, and also making sure if you're looking down that the people that are getting your stuff are the people you wanted to get your stuff, however that looks. It doesn't matter how that looks, but you want it going to where you want it to, that you really wanted in your mind to go. And beneficiary designations is a great first spot to start. We're going to look at the role of life insurance in enhanced planning. And I can tell you, I sit here every year, and unfortunately, we have one or two clients pass away. And life insurance can be a critical component of helping that transition, helping the family going forward. So we're going to tackle those three things. Again, folks, we don't have time to do the whole enhanced planning, but I'll probably do another show down the line that covers the other parts of it. But without further ado, to help us along with this, we have brought in, and this is a big get, Tony. This is a big get.
Huge.
I have Jay Guerin, the president. All right. We didn't go to the VP. We didn't go to any underlings. We went right to the top on this one because Jay has seen it all and done it all. He's the president of Gradient Life Insurance Brokerage, works with advisors all over the country, handling different life cases, big premium finance cases where we're really, trying to, get legacy together, and kind of everything in between, So Jay, welcome to the show.
Oh, thanks, Rob. Thanks, Tony. I am pleased to be here, and I'm actually kind of honored to have witnessed the technical malfunction firsthand. So
we're gonna look back. We're gonna look back and say, where were you when this happened? And we're gonna say, hey, we were sitting right there. We saw.
We'll look back on it and laugh because tragedy plus time equals comedy.
Exactly.
Good point. Well, Jay, first of all, welcome. We're very happy to have you.
Happy to be here.
Tell us a bit about yourself. Tell us about your journey to as you sit as the president of Gradient Life Insurance in front of us today?
Sure. So I've been with Gradient for 12 and a half years now. And I jumped over to the life insurance brokerage here about 2.5 years ago. And it's been a phenomenal experience being over on this side of the industry. And not only, I think, working with advisors like yourself, Rob, but also really just seeing the end result of life insurance. And I know a lot of times we think of it as death insurance, if you will, like you're only going to see something if tragedy strikes, but there's a lot of other ways to utilize life insurance, which is why it is a pertinent vehicle when you're talking enhanced planning.
Sure, for sure it is.
So my 2.5 years over on this side has been great, and I've really enjoyed really digging into the life insurance side of it, and the enhanced planning side of it is something I'm extremely passionate about. So I love that you're talking about it now.
Fantastic. So you're up in Minneapolis, right? Mm-hmm. So I'm down here in Naperville. Yeah, as you know, I've known Jay for all of those 12 and a half years, by the way, folks. I knew him when he was just a regular guy, I've watched the transition to president, and that's kind of how I can get him on the show. It's a previous relationship, so I'm able to do that. But
it's amazing to watch his climb through the ranks at Gradient.
Through into the clouds. Yeah.
I mean,
you guys are really building this up here.
He's on a trajectory that's just amazing. I think SpaceX and NASA want to figure out how he has that much of a trajectory.
Knocking on that CEO door.
Yeah. Look out.
Watch out, Chuck. Move over, Chuck, Lucius.
So I live here in Naperville. So in Naperville during football season and kind of almost any season, we have a lot of Iowa Hawkeye fans. All right. We're inundated with them. Like, you can't go to, a backyard football party or anything like that without, that's what we're watching. And I wanted to ask Jay if he had any connection to the Iowa Hawkeyes.
I do, Rob, actually. I do have a little connection there.
Wow.
So I did not go to the University of Iowa. Matter of fact, I went to the University of Minnesota. Which, if anyone knows the rivalry, it is quite the rivalry. But my oldest son is a sophomore at the University of Iowa now, and then my senior in high school is actually going to be going there next year as well. So that was a tough one in the Guerin household when I had to first tweet out or Facebook out "Go Hawks." I was on my phone and I'm like, I can't do it, Blake. I can't say "Go Hawks." I just can't.
But normally, if I see Jay when he's not sitting here, he has nothing but Hawkeyes gear on. It almost looks like he may be sponsored by Iowa.
I don't want to show you my shoes right now.
Okay, you got the yellow ones on.
The works. I'm in the same room with him, and just the Hawkeye socks.
Well, yeah, there's got to be something. There's always got to be something. So they go to Iowa, but what do they do there? Are they're studying, or what are they doing?
They are studying. They also are playing some baseball there.
Oh, so nice. They play for their Division I baseball team. You left that part out.
They do. So Blake, the sophomore there, is absolutely loving his experience. Our entire family has become massive Hawkeye fans simply because of the culture down there. The university is great. The Iowa City is great. And the culture of the baseball program is great too. So it's been a really good experience for Blake, and it made it a no-brainer for Tyler to go there next year too. So
that's fantastic.
That's a fantastic school. Big deal. With a great sports program. There's no denying.
Great school, and it's good for them. That's amazing. All right, so enough about Jay's life and his love of the Iowa Hawkeyes. I'm just trying to get favorable people in Naperville. You get on my side there because everyone loves Iowa. All right, so let's talk about enhanced plan. Let's get into it. So, Jay, let me ask you. What are ways that assets can pass to someone on death?
Yeah, that's a great question, and it's something that a lot of people really don't understand.
Right.
And you hear one of the words that you're going to hear is something that you hear all the time. So the first way is through probate.
Okay.
So probate is something that it's typically a scary word for people. Everyone says, "Oh, I want to avoid probate," or "How do I avoid probate?" or "Oh, that's a nasty process. It's lengthy and costly." So probate is the first way.
Okay.
And a lot of people are surprised at what falls into probate as well. So items like if property is titled in one person's name.
Okay,
So
like your house.
a house. Yep.
Okay.
And a lot of people, when you ask them, you say, well, how is your house owned? And you say, well, I own it. Okay. Are you sure? Well, yeah, I think I own it. Okay. And how is that house going to pass should you pass away? Well, it's going to go to my wife. Are you sure about that? And not a lot of people are sure. Once you actually start asking that question, not a lot of people are sure. And so for you to be jumping on this topic, it's huge because you're able to help all these people with this extremely important stuff. And now we're talking about a house and you're talking about assets. But the second type of property inside probate is non-titled property.
Okay.
And so some people, I mean, you entered the show talking about you want to preserve that family harmony and you want to make sure that the kids and grandkids are having Thanksgiving dinners together
100%.
when you're gone. The personal property is sometimes the biggest hiccup. It may be very well defined who gets what as far as the car and the house and the cabin and whatever else, but it's the art collection, the jewelry collection, dad's Camaro, those things that people fight over, and that's what can divide the families up as well.
Right.
And then
we see that a lot. I just had someone in the other day that exact thing is happening right now. Like they did a quasi garage sale of all the items. But if you weren't able to be there because you were away, well, you weren't in on the garage sale of being able to pick things. So that part that's a huge part that I think no one thinks about.
Yeah. And then the third one is tenants in common inside probate still. So tenants in common is when you have joint owners of something, some piece of property, some asset, but you don't have with rights of survivorship. So a lot of times this happens in businesses or non-spouse owners, right? So you have siblings that might own something equally, or the business, like I said. And so if there's two owners and one person passes away, if there's no rights of survivorship, that's going to go into the probate process to prove who gets what. So that's a dicey one. And then you have community property states, which Illinois is not a community property state. So
right in between us, Wisconsin is.
So yeah, absolutely. And so that's an important factor though, because even though Illinois is not, I would imagine some of your clients have property in Wisconsin.
Wisconsin for sure.
So not only that real estate that they own, but everything inside that house too is considered Wisconsin property. That's going to fall under community property rules.
Oh, interesting. Right. Even though the principal residence is here in Illinois.
Yeah, absolutely.
Oh, wow.
And so community property, because Wisconsin's so close, and this may be vital information to some of your clients, community property states that it should be a pretty easy process. It's the surviving spouse gets whatever left. Well, that's great. The reason it falls into probate is because you still have to prove when that property, when that asset or debt, you can't forget about the debts,
right?
When the asset or debt was acquired, because it had to be acquired during the marriage in order for it to pass to that surviving spouse. So it's still going to go through that probate process to prove who gets what.
Right. So if I had a lake house pre-marriage up there, it goes through probate, then it's up actually not going to my spouse.
That's correct.
Wow.
Yep.
Unless you somehow have it set up. I think you can put that property in a trust.
Yep.
Right. And have a beneficiary designation. For that.
So that gets us, Tony, that's a great segue because that gets us into the second type of the way things pass. And the way things pass, first you have probate, second you have contract. Okay. Contract, quite simply, is anything with a built-in beneficiary. So that's where life insurance comes in. That's where a lot of your investment accounts, as long as you've done the beneficiary assignments inside of those, the houses, if you put those inside of a trust, the trust has a built-in beneficiary. So that's where trusts, and again, we won't go deep into the trust like you said, but that's where those become a valuable vehicle inside of the enhanced planning process, because you can put every single thing inside that house, all those non-titled properties, all the titled properties, you can assign that to the trust. Now it's got the built-in beneficiary, and that's going to go to exactly who you want it to go to, rather than it going through the probate process. So the trusts are a great tool for that. And then, like I said, life insurance annuities, those have built-in beneficiary arrangements too, which makes them other great vehicles to help avoid those assets going through probate too.
Fantastic. And just as a planning point, your trust, if you have, and again, we're not getting into trust, but like a lot of people have wills and trusts, that document does not supersede the beneficiary designations you have, say in your IRA. If I have an IRA and I say my daughter needs, my daughter is the beneficiary of that, it doesn't matter what you say in the trust. That beneficiary, a beneficiary driven contract goes to the beneficiary.
That's correct. That one, your example's a little dicey just because if it was in the trust, then it would have to be titled in the trust.
Right.
But let's say a will. A will still falls into that probate process. Even though you've laid out exactly what you want to happen, that people still have to prove who owns what and who gets what. So a will falls into that probate process, and a will definitely does not supersede a beneficiary arrangement.
Oh,
so inside that life insurance contract, if whoever you've got listed as beneficiaries, that's who it's going to. Even if in your will you say you want it to go to person A and B, but in your beneficiary it's assigned to person C, it's going to person C.
So what you guys are saying is, if I'm understanding this, is any type of account with a beneficiary designation, like an insurance policy, would go to that beneficiary, and that beneficiary designation takes precedent over wills or
That's
anything
correct.
else.
Yep, absolutely.
Yeah.
Which again, a lot of people don't understand. And so you talked about the beneficiary designations, and that's why it's so important to be really constantly updating those beneficiary arrangements, right?
For sure, because they change.
Yeah,
people have grandchildren.
Yep.
And there's a new grandchildren, and they haven't updated that, or there's lots where there's, unfortunately family turmoil, and there's a child that's not kind of connected with the family at that point in time. Again, think about when you're looking down at the kitchen table and that one family member who you didn't want to have anything is getting their portion because you didn't look at your beneficiary designations often enough. And it's really something, Jay, that people should definitely look at, if not annually, once every couple of years, just as life changes, and things happen, and you might have different people that you want to get your money to, right?
My mom keeps the trust document magnet on the fridge, because anytime we upset her, she's like, "Oh, okay, I'm just gonna go make some changes quick." So
I'm gonna start doing that. I literally gonna start doing that. That is fantastic.
That's awesome.
Yeah. She reminds us that these things are written in pencil.
So. Right, and easily changeable. Your beneficiaries, folks, you can change those with a stroke of a pen. It's just a matter of that is an easy thing to do. So you want to definitely keep on mom and dad.
Speaking of which, Mother's Day is coming up, guys. So make sure that you're staying on the good side of the beneficiary arrangement.
I know Jay, like I think I do. He'll be there first thing in the morning with all sorts of stuff, making sure that magnet is where it should be on the fridge.
So Rob, when you work a lot with investments with your clients.
Yep.
So on investments like IRAs and stocks, are there beneficiary designations on those as well?
100%. So if you have an IRA or Roth IRA, again, there's listed beneficiaries that money will drive to upon passing. And if you have pardon me?
And that takes precedent over a will.
Over a will, right? And even if you have a non-qualified or an after-tax account, if it's not in a trust, if it's just in your personal name, there is a transfer on death that again lists beneficiaries. So you always want to make sure. You would be shocked. We obviously have a lot of money that rolls over from 401ks and things like this. Where the 401ks actually never had a beneficiary on them,
right?
Because I could have started at a job 30 years ago, and I wasn't married and I didn't have any kids, and it was just me. And I'll get to that later. And there's no beneficiary on it.
Yep.
And you definitely want to, if you're listening to this and you're working out there, get on your computer and make sure on your 401k there's a beneficiary designation, and it's still who you want it to get.
And what I like to tell people who are listening out there, they say, "Well, I'm not married. I don't have any loved ones. What am I supposed to do for a beneficiary designation? And my legal name is Anthony Shore. That's Shore.
How did I know that was coming?
I am more than happy to offer my services to be that beneficiary."
Don't write that down,
Tony.
All right.
And I will say too, there are things that happen in that beneficiary designation that screw it up too.
Okay.
One of the things that you see quite often is people say, okay, well, this has a beneficiary arrangement. I don't know who I want it to be. They list their estate as the beneficiary.
That's a really good point.
If someone lists their estate as the beneficiary, well, congratulations, you just threw that back into the probate process, because we now have to prove who gets what. So that's a way to take something from that contract status right back into probate by listing your estate. Do not list your estate. You want to have a person or an entity. The entity would be a trust as far as who's going to receive that.
And also, if it's a qualified account like an IRA, and you list the trust as the beneficiary, one, Uncle Sam is going to love you because you're going to pay tax on that money rather than having options. You know, we're not going to get into the tax or the options, but there's way more options if a beneficiary inherits something versus a trust inheriting something, where it becomes a tax bomb and like Jay said, in the probate or wherever.
And I will just mention briefly, so there's a third type of a third way that assets pass, and that is through joint tenants with rights of survivorship. So I talked about the tenants in common being inside of the probate process. Well, you have probate, you have contract, and then you have joint tenants with rights of survivorship. The with rights of survivorship is the big piece there. So that can be houses with a TOD, a transfer on death. It can be bank accounts with a POD. And you'd be surprised at how many bank accounts they don't just inherently have a POD. Even if I have a joint account with my wife, it's not a POD unless I go into the bank and say, attach a POD on this.
Interesting.
So there's a lot of people that it falls into that tenants in common rather than the joint tenants with rights of survivorship, and it falls into that probate status again.
And again, if you're listening, that seems like an easy thing to do. People are inherently a little bit lazy. So you go into the bank, you get that document, you fill it out, done. Rather than again looking down and going, oh geez, that didn't work out. These are easy steps, folks, when you're listening, to just when you're write it down, check a box and go, you know what, we got to do this. And that's what this enhanced planning is all about. It's kind of organizing, what am I missing in my plan, and how do I let's take care of these little spots that I have blind spots in. And
we're all invincible. We all believe we're invincible until tragedy strikes, until we're not. So something that a line that I've heard that has been really effective, and it's a bit morbid, but the line is, pretend I'm talking to your corpse right now. What would you have done differently today? What would you have done differently with how these things are titled and the who gets what side of things? Because 20 years from now may not happen. And again, no one is
morbid, by the way, Jay. Thank you.
It is. I don't know how else to say other than corpse. Like, pretend I'm talking to your ghost.
You went.
I don't know.
Yeah, ghost might be a little better. You went dark.
Like I said, but it gets the point across, right? It's pretend tomorrow didn't happen.
Right.
What would you have changed on how things are sitting right now?
And I would think, a lot of people don't want to deal with this because they think it is a death sentence. A lot of people don't get trusts because they think as soon as they sign that, something bad is going to happen. Doing those planning things, and people plan for a vacation much more in depth and much longer than doing this kind of thing. But this kind of stuff is the most important stuff you can do, because again, you want your stuff that you worked hard for or your family worked hard for going to the spots that you believe it's going to. And as Jay is saying, what you believe and what is reality are two different things, so you want to make sure that these documents are in order and that it is going, and that peace of mind will, probably have you live another 30 years, and again, you can't control anything, but having these things in order, it just makes a whole lot of sense.
Well, and I'll say too, if you, if you pass away without a plan, the state has a plan for you.
Right.
So that's called dying intestate. So there are intestacy laws, and they're different in every state. So I don't know what Illinois are and how they would treat my situation, but I've got two kids from a prior marriage, the 20-year-old and the 18-year-old.
Baseball players.
The baseball players. Yep. Go Hawks.
Yep.
I've also got my wife and my two kids in my current marriage. Well, if I passed away right now, the state of Minnesota would say that Molly, my wife, would get 50% of my assets, and my two kids from my previous marriage would split the other 50%.
Oh,
it's probably not going to go over really well. I don't need the 18 and 20-year-old trying to figure out how to sell half of a house. That's kind of tough to do.
Right.
but also inheriting the little bit of wealth that is there, right? Like I don't need the 18-year-old going out and buying a new car because he just received.
I think Ty and Blake would have just a fantastic time. They'd find ways. They'd find a way to spend it, G, if that's your concern.
Yeah,
the economy in Iowa City would have a boost. I'm assuming.
But that's interesting how and then you have to tackle that where you're at and go, okay, how do I solve this to make it the way I want it to be, right? And then you have to do the documentation that's necessary to do that and have it going, to where you want it to be going.
Yep, absolutely.
Right.
Absolutely.
And if you didn't know that, there's that situation is not that's a weird situation. There's lots of people married, had a few kids here, remarried, had a few kids. There's tons of them. So that situation is probably more common than what people think. And I can guarantee you, because I would never have thought that until you just said it on air. I would never think that that's the split that happens.
Right.
That would never cross my mind. So very good point. Let's tackle one more, Jay. Before I let you go, let's talk about we're on these beneficiaries, how assets are passed. Let's talk about beneficiary designations.
Mm-hmm.
And there's two major kinds. Can you talk about those? Because they're huge.
So you have per stirpes and per capita. So a lot of times you'll see these on beneficiary designation forms. A lot of times you won't. And so if it's not listed, that company has a default. It's either per stirpes or per capita. You may not know which one it is. And per stirpes, do you want me to get a little bit technical?
Yeah. No, 100% get technical.
So per stirpes means per branch. Okay. So let's just say I've got two boys, right? And they're married and have kids and everything there. So I have two branches that I say I want 50% going to Blake and I want 50% going to Tyler.
Okay.
And if I have it listed as per stirpes, if Tyler were to pass away, if he were to predecease me and I didn't update my beneficiary arrangement, Tyler's kids would still get that 50% of his money. That's what I would want to happen. I want 50% to go to Blake's family and 50% to go to Tyler's family. So that's per stirpes. That's per branch. It's just going to stay in that branch no matter who the next beneficiaries are.
Right. So it stays with if you get two, like you said, someone predeceases you, it stays with the family, because a lot of times, if they're both married and have kids, you're going to know the spouses, and they're really be part of our family. And I had someone in this yesterday that her husband had passed. It wasn't listed per stirpes, for his brother's estate, and his brother was a bachelor. Wasn't listed per stirpes, and it's flipping over. You'll get into it, but it's not going down the branch. Which he fully intended that to happen.
Yep, absolutely. And again, it doesn't matter what the will says. The beneficiary designation is it's going to be. And so per capita is the other way. Per capita means per head. And per capita means it is specific to Blake and Tyler. If Tyler were to predecease me, same example there, right? He no longer exists on that beneficiary arrangement. So 100% would now go to Blake because he's the only one left in the per capita listing.
Right.
So I've just disinherited my grandchildren on Tyler's side.
Right. And probably his spouse.
And
that probably needs that more than anything if something had happened, right?
And again, if it's listed on the beneficiary document, great. You can choose per stirpes all day.
Right.
And again, I don't want to go that side of it, but maybe you don't love the spouse of one of your children, and so you want to keep it per capita.
Not a fan of the in-laws or the grandkids.
But that actually, it's a joke, but that does happen. Like if someone is married in the family and they don't have kids, and you're not a fan of the spouse. I've had people choose per capita because of that.
Yep.
Because they're like, I don't want him or her getting any of my money. I don't, whatever the reasons are. So you have to look at it from your own situation and say, where do I want my money going? And do I want it going, down the branches, or do I want to make sure that it stays very solidly with my children, my first line, and
a lot of those beneficiary forms, if they don't have it listed, you just include a letter of instruction that says, to be included with the beneficiary designation, I want it listed as per stirpies.
Right.
So that you don't go to the company's default of whatever they have, because sometimes you don't know what they have unless you ask. But
right. Very good point. Well, very good points today, JJ. I had a whole other section to talk about with you that had to do with life insurance, folks. So we'll have Jay back, and he is the president of life insurance. But like these points are very, very important. But today we don't have time to get to it. So we will bring Jay back. I promise you all, we will bring him back, because the next section is critical, and the different ways that you pass generational wealth on to people, or, help people in situations, or whatever you're trying to do with your money. Jay's got a ton of insight on that, and we will bring you back. But Jay, I want to thank you for coming. This was great. This is information that anyone listening, listen through it again, write down what pertains to you, and take care of it. Just remember what I said at the beginning. When you're looking down at the kitchen table, you don't want them saying Dad was disorganized and this was a mess, and how did he do this to us, and blah, blah, blah. You want to say, wow, everything is in order. Oh, what's per stirpies? Oh, this is the way Dad wanted it. Okay, great. Wherever you want your money going, and whatever you want your legacy to be, use these points that Jay spoke about today, and just start taking care of that. That's the back office stuff. And when we bring Jay back in, we'll talk more about the front office, the stuff that has more tangible value.
Excellent. Rob, thanks for having me. I appreciate it. Would love to come back.
Perfect. Thank you.
All right, guys, that's awesome. Listeners, thanks for tuning in and viewing. That does it for today's episode of Ready, Aim, Retire with our host, Rob Kirvan, and special guest, Jay Guerin.